The continued opening of China's capital markets will represent a generational structural shift for international capital flows. So far, most of the attention has been focused on investment into China. In our view, capital coming out of China is likely the more important story. We've published our first report, Harnessing Southbound Sentiment, in a series looking at the implications of China's capital markets liberalization program. What's the scale of the opportunity? Well, China saves 47% of GDP and has 89 trillion renminbi, or 12.6 trillion US dollars of household savings to deploy. How Chinese households invest their savings will be one of the key long-term questions for global asset prices as liberalization accelerates. Currently, this QE-sized wall of capital is largely confined within China, fueling massive onshore liquidity. As restrictions ease, the resulting outflows will have similarly outsized impact. The first testing ground of this trend is the Stock Connect program, which facilitates cross-border capital flows between Hong Kong and Chinese stock markets. The southbound flows from domestic investors have reignited liquidity in Hong Kong and are now the key marginal driver of stock prices. How significant have southbound flows from China been? Well, southbound investors now hold over US $160 billion of Hong Kong listed stocks and are amongst the top holders of the individual stocks that they are active in, including many of the largest companies listed in Hong Kong. In terms of turnover, southbound investors have accounted for 20 to 25% of gross turnover year to date, representing the highest levels seen since the program launched in late 2014. Their impact has steadily increased since the launch of the program, a trend we expect to continue given the huge scale of Chinese capital relative to Hong Kong liquidity. In the near term, Chinese investors have recorded USD 32 billion of new net inflows since December 2019, marking an all-time high despite the COVID-19 crisis. Understanding the investing style of southbound investors is critical for the Hong Kong markets, as they possess both a liquidity and information advantage. This is amplified as other investors factor in expected southbound impact. Our analysis shows that southbound investors have a much more idiosyncratic focus compared to international investors. We believe they are a better informed investor group relative to offshore investors. We cross-reference top-down company holdings with shareholder-level disclosures to better understand the identities of major southbound participants. We find that institutions such as state-owned enterprises, government-linked, and employee stock option plans often make up the majority of the southbound stake. This is complemented by local funds with an on-the-ground advantage. Contrary to popular belief, southbound investors do not chase momentum, but show strong signs of being stock pickers. These factors, in conjunction with the high quantum of liquidity, typically lead to significant outperformance of stocks targeted by Chinese investors. In order to take advantage of these trends, we use machine learning techniques to identify the most informative southbound trends and how they predict future stock level alpha. We find the most salient metric to follow is to look at the combination of the previous month's flow and the consistency of the inflows that we see into each stock. This signal shows a strong, nonlinear relationship with next month's alpha, with the highest predictor score leading to the most outsized realized alpha. We have created our Credit Suisse Southbound Sentiment strategy to help investors take advantage of this trend. The strategy backtest of our preferred implementation shows a 1.6 Sharpe ratio, an 11% average annual return, a 9% maximum drawdown, and around 0 beta to the broader market. For fundamental-oriented investors, we recommend utilizing the signal to augment their existing investment processes, bolstering conviction, sizing positions, timing execution, and avoiding short squeeze candidates. We believe that studying the trends of southbound investors can provide significant insights into what to expect as China further liberalizes its capital account, as well as provide an attractive opportunity to boost alpha generation in Hong Kong.